Woolworths trading update. The company expects first half headline earnings per share to gain between 35 and 45%. That's after cutting aggressively on the cost line across the board. Your view on Woolworths right now?
I guess the 35 and 40 to 45% up is aided quite significantly by the STC charge, which depressed their base last year. If we try and strip that out and normalise that over a full year, we reckon HEPS could be up 10% for the full year and maybe a bit higher for the first half, very much in line with where their revenue growth is. I think their revenue growth was up about 9.3% for the 26 weeks. We were looking for around 10, so broadly in line with expectations. But yeah, I think that 35 to 45 is a couple of funnies coming through that number that will normalise over the full year.
In the retail space, is Woolworths perhaps one of the better players?
We still would prefer slightly more defensive plays, something like a Pick n Pay, which has got less clothing exposure and a lot more food exposure. Woolworths also has been on a sort of a tremendous rally from the March lows and making new highs at the moment. On a forward PE market, on the market earnings of about 140 cents of about 12.5, 13 times. We think there's better value elsewhere. Like I said, Pick n Pay, some of the other defensives like Mediclinic.
Fin Media 24 is reporting that Naspers is to fire workers in the South African space. The stock today trading up 0.75% at R284.99. Your view on Naspers and this news flow that has just come to our attention?
Yeah, the news flow is on the print media side, and Naspers has, over the last couple of years, actually diversified quite a lot away from the print media business. It's more of a sort of content provider, internet company now. So while it's obviously sort of very bad news for those people who lose their jobs, it's not a massive driver of the Naspers business, which I think at the moment is really being driven by the internet strategy and Tencent in China.
Turning our attention to BHP Billiton, the world's largest miner, saying that its outlook for commodities since the global downturn is very positive, and it's reporting record iron ore shipments, setting the stage for higher metal prices this year. We are seeing metal prices today under pressure as a result of the weak euro translating to a strong dollar. But do you subscribe to the stronger commodity view over the longer term?
Over the very longer term, we do believe in the sort of China commodity boom, which will drive commodity prices higher. So on the very long term, we are sort of constructive on commodities. Having said that, we are worried about China in the near term, and our view is that part of the reason for the decline in commodities today, and also in the BHP share price, was also sort of rumours coming out of China that the government is trying to pull back on bank lending in China. And we believe that bank lending has been very supportive of commodity prices in the last 12 months or so.
That move, obviously, by the Chinese authorities is to curb inflation in an economy that is potentially overheating. Do you subscribe to that theory?
Correct. I mean, in one of our previous newsletters, we showed very distinctly how sort of the money supply in China tends to be a very good lead indicator for inflation. Money supply has sort of grown exponentially in China. Their inflation numbers are out tomorrow. I think consensus is looking for about 1.5% inflation in December compared to about 0.6% in November. But we wouldn't be surprised if their inflation numbers had a 2 handle in it. And that's really why perhaps the Chinese government and authorities are preemptively trying to move to sort of obviously try and tame inflation fears.
Johny,
so we think inflation could get out of control in China.
What is your stance on equities in the South African space at the moment?
We're still conservatively positioned. We have been since the middle of last year. We think the markets have run ahead of themselves, and we can see the panic in the markets when either there's talk of US interest rates or China removing that stimulus as we saw today. So we think a lot of the sort of rally in risky assets has been driven by a lot of that accommodative policy, and in 2010, governments around the globe are going to have to try and to remove this accommodative policy that they've had, quantitative easing in the Western world and sort of huge bank lending in China and the East.
Johny, I appreciate your time. Johny, sorry, continue there. I don't want to interrupt you.
No, as I was just going to reinforce that we are sort of conservatively positioned both within equities and within our asset allocation portfolios as well.